are cutting back on staff and business expenses, but will it be enough? Joining us now is Michael Rice of management consulting firm Novantas. Welcome to the show this morning.
Thank you.
So you keep your ear close to the ground. You're watching what's going on with the big banks around the nation. We're hearing a lot about cutbacks. What do you think is the average attitude towards banks at this point?
Well, I think there's still a lot of skepticism by consumers related to their banks. We saw what happened when Bank of America tried to charge consumers for their debit card. So I think there's still a lot of uncertainty that will consumers build back a positive feeling towards banks. And we see a little bit that also on the commercial side. Corporations also are a little dissatisfied with their banks, or starting to consolidate relationships.
And then you have big companies out there like Citigroup saying that they're going to slash 4,500 workers. They're targeting reducing expenses by 3 to 5%. Bank of America wants to cut 30,000 employees. Are banks becoming too lean, or are they still bloated?
And what banks are really faced with is this revenue drought. If we look at the last 2 years, bank revenues have not increased at all. That's for a number of reasons. We see consumers deleveraging, we see corporations deleveraging, we see fee income opportunities being reduced because of all the regulatory changes. And we think that took about $30 billion of revenue out.
Do you think regulations are really having that big of an effect on banks?
I think it's significant, and I think it'll actually, the full impact will not be felt until 2012. In addition, there's going to be added liquidity requirements, capital requirements that will also drive costs up in banks.
Well, the banks that rely on revenues from trading are having a difficult year because it's very volatile out there. So do you suspect maybe they will try to bring on more consumer fees to make up for that money?
Well, you know, it's like a balloon, right? You push in one spot, you want to reduce fees because of regulation. It's got to come out in another place. So I do think the banks will look for additional fee income opportunities. And the trick is going to be to generate those in a way that commercial clients as well as consumers are willing to pay for it.
Do you think there's any upside to regulations? I mean, clearly there was a lot of Rambo trading that was going on by these big banks. Risky trades were made, a lot of money was lost. The taxpayer is footing the bill.
Well, I do think regulation is good, right? We do not want, first of all, we want consumers protected, right? We want disclosures, we want communication, we want transparency in what we're doing. So I think that's good. I think the question is we need to make sure that we're doing it in a measured way and making sure that we're not having unintended consequences. So one unintended consequence right now is that credit is harder to come by. And some of that is driven by the regulations, the additional costs, the additional capital that is going to be required by the industry.
What are some solutions you would offer? First
and foremost, banks, to be more productive, have to be more precise in how they target customers. So if you think about the average consumer is deleveraging, there's this real structural change going on where consumers were more focused on consumption and borrowing, and today they're more focused on savings and deleveraging.
Yes, they are.
So what you have to do is find those niche of customers that actually still want to borrow, give them good products where they see value. There's an honest value exchange. The bank makes money. You get a product that you need. So we see more precision around segmenting, and pricing is one way that banks can be effective.
Michael Rice, thank you for your time.
Thank you.